Hello everyone. In this video we'll be learning about accounting standard 2, that is valuation of inventories. Now, what do we mean by inventory and why this standard is necessary? Understand, suppose we are having some units of goods in our godown, okay, the cost of which is say 10,000 rupees. Okay, so you will say, sir, it is very easy. If we know the cost, then you can directly say that much amount you can write in the balance sheet under inventories. See, the problem is that in the market value of our goods can be either 8,000 also, or there can be a case that the value is 11,000. Then what should we do? That is the first problem. Another thing is that how to recognize whether this inventory will appear in the balance sheet or not. See, those are the problems which have happened in the past, and that's why accounting standard 2 came into existence, because it will help us to whether we have to show inventory or not in the balance sheet and at what value. Understood? Now, we'll begin with the objective of the accounting standard. See, what does it say? To determine the carrying amount of the inventories in the financial statements. Financial statements are profit and loss and balance sheet. It affects the profit of the current year and asset value in the balance sheet. See, how does the valuation of inventory affects the profit of the current year? Understand, we used to prepare trading account. So in trading account, we used to write here buy sales and then buy closing stock. Hey, you remember no, 11th standard, first PUC, buy closing stock, and here we used to write to gross profit. So understand, if closing stock, suppose I had to write 10,000, but by mistake or by my calculation I have written 11,000. Okay, so the gross profit will also increase by 1,000. Understood? So to avoid these mistakes, we have to carefully value our inventories. Okay, this is the first thing. And asset value in the balance sheet, because we know where do we write inventories? We write inventory in the current asset in the balance sheet. So these both can be affected. That's why it is very important to learn the valuation of inventories. Now, see, what is the scope of valuation of inventories? This asset, see, the standard is not applicable for the following inventories. See, whenever I am saying it is not applicable for them, it means we have already another accounting standard for those particular things. Okay, and if not, there is some explanation which is already given. Now see, understand, work in progress arising from construction contract. Why it is not under AS2? Because we cover this under accounting standard 7. Construction contract means suppose we are in the business of constructing. Okay, so construction of buildings, construction of flats. Suppose as on 30th March or 31st March, the flat we are constructing is only 70% done, 80% done. So how much value you have to write? That and all this accounting standard will not cover. We have to deal in accounting standard 7. Okay. Then work in progress, WIP of service providers. What is that? See, service provider, you can say, suppose you are the auditor. Suppose you are auditing some company, okay, and as on 31st March, you have completed 40% of your work. 40% of your work is completed. But now, how will you write it in the balance sheet and inventory? What will you write? That I have already checked profit and loss. We have already checked the bank balance. You cannot value those items. That's why it is just impossible to write the work in progress or inventory for service provider. Understand? Service provider is providing services. They are not in the selling or manufacturing of goods. Okay, so inventory will not appear for them. Now, what is the third point? If the entity holds shares, debentures and other instrument as stock in trade, that we will cover in accounting standard 13, and we are not dealing that in accounting standard 2. Next is inventory of livestock. Livestock means suppose we are in the business of milk products. Okay, milk products, and we do have cows, buffaloes in our godown, not in godown, but you can say in your backyard, or that is our main business. Or agricultural products, we are in the business of agricultural product, forest products. So all that will be covered in the accounting standard 10. We are not covering it here. Okay, now this was the scope of accounting standard 2. Now we will learn about what do we mean by inventory. See, it becomes very important to understand, because from here only our accounting standard begins. To value the inventory, we must know what is inventory first. Okay, now see, let's say we are in the business of manufacturing shirts. Okay. Sir, do we have a factory? Yes, we have a factory now. See, this is our factory. Sir, how many shirts are we manufacturing? How many shirts do you want to manufacture? Sir, we want to manufacture 10,000 shirts. Brilliant. But tell me, to manufacture 10,000 shirts, what do you require? Sir, we require building, machinery, land we require. See, all those things are fixed asset. For that, we have another standard, that is accounting standard 2. You will tell me that to manufacture shirt, the core product, what do we require? Oh sir, like that. Yeah, so like that sir, you can say you will require raw material. Raw material? What kind of raw material we require? Sir, you will require thread, you will require cotton. Okay, wait. I will require thread, cotton to manufacture shirt. Anything else we require? Sir, you will require buttons also. Okay, buttons we will require. That's it. That is our main raw materials. Very good. After that, sir, after that we will put that into production. Okay, so I can say that this raw material will be transferred to the factory. Yes. Now, from factory, what will we get? Sir, we will get shirts. Okay. So, we are getting shirts. Shirts is our final product. So, can I say when this shirt is completed and finally packed into a box, then I can say this is nothing but my finished goods. Yes sir, you can say that it is my finished goods. As soon as I say this, no, a student tells me, sir, will every day we will be producing shirts? Definitely. But sir, is it not possible that there are many shirts which are incomplete also by the end of the day? Obviously, suppose our factory is working till 6 p.m. or 8 p.m. whatever timing it is. See, if factory is working, so every day it is possible that I am putting say 1000 kilo of cotton or so much of thread or so much of raw material, and factory says, suppose factory has manufactured 200 shirts. Okay, I am talking as on 31st March. As on 31st March evening, factory has dispatched 200 shirts, finished goods. Okay, and factory tells me that for 70 shirts, no, the work is not completely done. Sir, what do we mean by not completely done? See, they are saying for 70 shirts, buttons we have not put. Buttons are yet to be placed. Okay, and buttons are not put and the shirt are not ironed properly and packing is also not done. So what is done? They are saying we have stitched the shirts, stitching is complete, but putting the buttons, ironing the shirts, packing, all that is pending. Now if I tell you, just think and tell me, can I sell these shirts into the market? You will say, sir, obviously not, because buttons, iron, packing, they all are the important things. Buttons are very important. You cannot sell these shirts. If I ask you, can I sell these 200 shirts into the market? You will say, sir, yes. Why? Because that is my finished goods. Can I say everything or every goods which are ready to sell, you can say that is finished goods, that will form part of inventory. So this is the first thing. Another is, when I am transferring so much raw material to the factory, obviously in my godown I will be having a lot of raw material also. Understood? Because I will not be buying raw material every day, no. So as on 31st March, I can say that I still have 300 kgs of cotton, thread, or you can say I have some 10,000 pieces of godown. Okay, sorry, 10,000 pieces of buttons in my godown. So that is the stock of raw material. Understood? See, understand, from our childhood in commerce, no, we always think that inventory is stock, stock is inventory, both are same words. No, they are not the same words. Stock, you say anything in a group, we call it as a stock. Stock of raw material, stock of finished goods, stock of laptops, that like that you can say that anything, if there are so much in quantity, you will say stock of that particular thing. Like that, stock of raw material, stock of finished goods are called as inventory. See, if I break the word inventory, no, you can also understand whenever the invention of a new product takes place, that is called as inventory. Okay, in our case we are manufacturing shirt, we are borrowing, we are purchasing raw material, work in progress, machines we have put. Why? to produce a new product, that is shirt. Understood? So you will not say that stock itself is inventory. Okay. Now coming back to our story, raw material is my inventory, finished goods is also my inventory, and these 70 shirts, if I ask you, are they finished goods? You will say, sir, no, they are not finished goods. Are they raw material? You will say, sir, you cannot say it is the raw material because stitching is done. Then what are they called as? They are called as work in progress, WIP. Understood? You would have seen in many cities the metro work is started, so and when it will be completed, that only God knows, but they put that hoardings, no, work under construction, work in progress, all those things. Like that in manufacturing shirt also we say these 70 shirts are work in progress. Simple. Now these are our inventories, and one more last part is, see, whenever the shirt is ready to be sold, okay, now you will say it will be packed in a box. First you have to place that shirt in a particular packing, plastic packing, then it will go on in shirts. You will be using staplers, you will be using scissors, sellotapes and all those things. Now those all things are called as loose tools, or you can say consumables. These are those things which help us indirectly in selling our final product. Okay. So now we will write the definition of inventory, including all this story, whatever we have learned now. Understand? First thing is, inventories are, just a second, inventories are assets which are held for sale in the ordinary course of business. In our godown, what do we hold? We hold shirts. That was our finished goods. Finished goods. In our example, they were shirts. Okay. Then after that, inventories are assets which are used in the process of production for such sale. Which sale? See, held for sale, no? So whatever we are holding, the raw material work in progress which are used for the production for such sale, for this sale we are talking, what were they? That were our raw material and work in progress. And the third was which are used, or you can say consumed, in the process of production. For example, loose tools. You can also call them consumables. What were they? We know that staplers will be used, staplers, scissors, okay, you can say sellotapes, and all those things we can use. Understood? Now everything will be appearing under inventories. Where do we write inventory? In the current asset in the balance sheet. Now the first capsule we have here is, see, capsule number 1. What does it say? X Limited manufactures soaps. It requires oil which is bought in tins, and at the end of the year the company has 1 lakh empty tins and containers. अच्छा, इसका मतलब देखो, soap बना रहे हैं, soap is our final product, oil is our raw material, we buy oil in tins, so at the end of the year the company has 1 lakh empty tins. Okay, the entity sells the empty tins at 2 rupees each. Okay, so the worth of tins held by the company is 2 lakh, obviously, because 1 lakh tins we have 2 rupees each, it will be 2 lakh rupees. Now, which is a material amount for the entity, okay, the accountant of the company wants to disclose the empty tins as inventory. Empty tins, they want to show it as inventory. Do you agree with this? Give your answer with the reasons. See, they are saying that we bought so much oil that now we have 1 lakh empty tins. Now they are saying that if we sell these 1 lakh empty tins, no, we'll get 2 rupees each for each tin. So they are saying that we want to disclose that in your inventory, that in the inventory in the balance sheet. Can they do so? Understand? They obviously cannot do. See, as per accounting standard 2, inventory is an asset. I have told you, you have to write the definition, which is held for sale or used in the process, consumed in such process. Containers and empty do not satisfy the definition of inventory. Arey, think, how will the empty containers or empty tins will help in the production of soaps? Obviously it will not help. Now, inventories, as these are not held for sale in the ordinary course of business. See, X Limited is saying that we will sell those tins again, but understand, it is not in the normal course of business. What is the normal course of X Limited? It is manufacturing soaps and selling the soaps, but they are here talking that they will be selling empty tins. Understood? Now, and these are not used. See, now empty tins are not used, empty tins are not consumed, and empty tins are not our main business. So you can say, hence classification of empty tins under inventory is not correct. Obviously it is not the inventory. Now, but these will satisfy the definition of an asset. Hence the entity should recognize the asset at its net realizable value, that we will learn in the further concepts, and present it either as current asset or non-current asset depending on the expected realization time. See, they are saying you cannot say that these tins are your inventory, okay, but definitely these tins are our assets, okay, they are assets, so you can classify them as current asset or non-current asset based on the time limit when you are going to sell them. If you are going to sell them and realize the cash within 12 months, it is very good, but if you are going to sell them and realize the cash after 12 months, it will be non-current asset, obviously. Now, this was our capsule number 1. Further, now we'll read about capsule number 2. See, A Limited is engaged mainly in the purchase and sale of wines. Okay, it decides to acquire 20 constructed flats and renovate and let them on lease. See, the main business is of wine, but now they think to construct 20 flats. They want to construct 20 flats. Why? To put them on lease. Okay, to put them on lease. Why? Because they want to earn rental income. Which income? Rental income. Okay, now understand. Why? To understand this is very necessary. They are not constructing 20 flats to resell them into the market. Okay, this is the first thing. Second is, flat construction is not their ordinary course of business. Their ordinary course of business is wine. Okay, now during the year end, company had let out 9 flats and 11 remained vacant. It means they are saying out of 20, 9 were put on lease and 11 flats are vacant. Okay, means they are empty and nobody has come there. It is not on lease. Now, due to appreciation in value of flats, A Limited sold 11 flats with huge profit margin. Now they are saying we sold it. They sold these flats with huge profit margin. Management disclosed the sale and purchase transaction as sale of goods and the profit on such sale is recorded as direct income. देखो, मैनेजमेंट ने क्या गलती की है? मैनेजमेंट बोल रहा है कि these flats what we constructed and what we have sold, it is in the ordinary course of business and they have recorded it as direct income. But understand, this is wrong. Why? Because our main business was of wine. The income from wine should be our direct income and the income from flats should be our indirect income. But they did the wrong thing. Why? Because they accounted profit on such sale of flat as direct income, which is wrong, and treated lease income as indirect income. Understood? Lease income as indirect income is okay, but the selling of flat as direct income, that is wrong. Now we'll read the answer. Look there. As per AS2, inventory is an asset intended for sale. This is the definition. Whereas as per AS10, fixed asset is an asset held for producing goods or providing service, but not held for sale in the ordinary course of business. Okay, in the given case, A Limited's intention of acquisition of flat is to use the flat to generate lease income. Okay, and are not held for sale in the ordinary course of business. देखो, फ्लैट बनाए थे, फ्लैट कंस्ट्रक्ट किए थे, क्यों? ताकि हम लोग लीज इनकम कमा सके, not for selling that flats. Okay, now hence these flats should be classified as investment property rather than inventory. You cannot classify them as inventory, it should be classified as investment property, which we will learn in accounting standard 13 in detail. Okay, now therefore the profit from sale of such flats should be classified as indirect income. The selling of flats, the lease income, everything is indirect income, and it requires separate disclosure as an exceptional item in accounting standard 5. Why? Because that is not our normal ordinary course of business. Therefore, management accounting treatment is not in accordance with the accounting standard. It means they showed it as direct income. The selling of flat is not direct income, it is only indirect income. Understood? Now, further we have capsule number 3C. Radha Limited is engaged in the business of refining and transportation of crude oil through pipelines. Okay, the length of pipeline is 50 kilometers and it should be filled initially with 50 lakh liters of oil. Now understand what is happening here. First, I'll tell you what is the story. See, suppose here is some Radha Limited in say Bangalore. Okay, and from Radha Limited there is some, the underground pipeline is there. This is the land and this is the pipeline from Bangalore to Hosur. Okay, this is our Hosur. Okay, the entire pipeline is 50 kilometers. Now, Radha Limited is in the business of oil. They will transfer oil here, and from here we will be giving it to three different companies. That is, first is Bharat Petroleum, then here Hindustan Petroleum, and say another company, that is you can say Indian Oil. Okay, now understand with me. Radha Limited is engaged in the business of refining and transportation of oil through pipeline. The length of pipeline is 50 kilometers and it should be filled initially with 50 lakh liters of oil. So they are saying it should be filled with the 50 lakh liters. So we are filling it with 50 lakh liters of oil. 50 lakh liters oil. Okay. Now after this, say the entity wants to transport 10,000 liters of oil from one end to another. Say, suppose this Hindustan Petroleum gives an order or places an order with Radha Limited and tells them to send 10,000 liters, only 10,000 liters. Okay, so I am writing here order of 10,000 liters of oil. Okay, now Radha Limited has to transfer 10,000 liters of oil. So what Radha Limited does, they will put here, I will making here some jug. Okay, and they are putting here oil. How much? 10,000 liters. Okay, who's putting oil from the jug? This manager is putting. See here, this manager is standing here and he is putting the oil. Okay, now he is putting the oil into this and it will be transferred to Hindustan Petroleum. Here we are transferring. Now after this, see, it is very important, please be with me. If it fills 10,000 liters in the empty pipeline, it will be in the pipeline only, obviously. Understand, we have to fill that entire 50 kilometers of pipeline with that 50 lakh liters of oil. Okay, because if suppose the entire pipeline is empty, okay, suppose this is the pipeline, an entire pipeline is empty, even if I put here 10,000 liters of oil, so it will be this much only, and I have to reach here to the Hindustan Petroleum Company. Okay, it will not reach. So this pipeline should be entirely filled. Understood? Now we have already filled that. You can understand from the picture here that if I am putting a 10,000 liter of oil here, okay. I am who Radha Limited is putting here. So this oil which is already present here, no, this is the old oil which is already present here, it will be transferred to Hindustan Petroleum. Understood? And this pipeline will always remain full. This is how the business of oil, this is how the business of petroleum is run, okay. That this much petrol will always be in the pipeline only. You cannot say that we don't want that. You cannot supply petrol only, you cannot supply oil. This much should always be in the your pipeline, okay. Now after this, the entity should fill the oil at the beginning to start transportation, and stock in the pipeline is a permanent stock which cannot be sold. Now understand, 50 lakh liters of oil we are talking about, okay. So 50 lakh liters of oil will always be present in the pipeline, understand. So as on 31st March also, that will be our closing inventory. Now can the entity treat the stock of crude oil in pipeline as inventory? Understand this. Can you call that crude oil which is in your pipeline from the viewpoint of Radha Limited? Can Radha Limited say that this 50 lakh liters of oil is my inventory? Yes or no? That is what we are going to study in this question. Look at the answer. As per S2, inventory is an asset. The again definition, the crude oil in the pipeline is held for sale. See, obviously it is held for sale. The oil in the pipeline is always replenished, means you can say it will be always changed, because this manager here will always put new oil every time. Hence it is concluded that the oil in the pipeline at the end of financial year is held for sale in the ordinary course of business. Obviously Radha Limited's main business is what? Selling oil, and it should be treated as inventory as per accounting standard 2. The oil is not held to produce or provide service in the ordinary course of business. Understood? So you will say that that oil is always will be treated as inventory. Now the fourth capsule, it talks about whether spare parts, servicing, standby equipment are inventory or not. See, spare parts, servicing and standby equipment which satisfies the definition of property, plant and equipment as per accounting standard 10 will be recognized as PP, okay, and it should be accounted as per AS 10. If these do not satisfy PP definition, it will be treated as per accounting standard 2. Simple. You can check. First thing is you have to check whether it is fixed asset, that you have to check with accounting standard 10. If it is not fixed asset, if it is not property, plant and equipment as per AS 10, you can say we will calculate the value as per accounting standard 2. Very easy. Now the next thing we have here is measurement of inventory. See, we already know we had three things: raw material, work in progress and finished goods. Now I have to value that. So first we will learn about finished goods and work in progress. See, very easy. Understand. First is finished goods or work in progress. How do we value that? Inventory is valued at cost or NRV basis, whichever is lower. Okay. If suppose they say cost is 1000 rupees and net realizable value is 800 rupees. Net realizable value means that value at which you can sell that inventory in the market. Okay. If I can sell it at 800, but my cost of manufacturing itself is 1000 rupees. Okay. Then I have to write that the value of my inventory is 800 only. I will write 800 only in the balance sheet. But sir, if I have spent 1000 rupees on my product and I am valuing it at 800, don't you think it will be loss? Very good. So it means there will be a loss of 200 rupees. Understand this. There will be a loss of 200. About that loss will be transferred to profit and loss account. Okay. Sir, can there be a situation when the cost is 1000 rupees but net realizable value in the market is 1250? Yes, there can be a situation. But then sir, you are saying that the lower should be the value. So I have to select 1000 rupees, correct? Then sir, why can't we select 1250? Why can't we select the higher price? That is what the doubt of the student. Now understand. Cost is 1000, NRV is 1250. Student is telling me value it at 1250 because you can sell in the market at 1250. But you cannot write. Why? Because account says we have to follow concept of prudence. You cannot write profits now. Okay. The future profits, if you are expecting profits in future, you cannot write it now. because we have to follow concept of prudence, that is conservatism. We have talked in detail about concept of prudence in accounting standard 1. Okay, now coming back to the measurement of inventory. Inventory is valued at cost or NRV basis, whichever is lower. Then about raw material, understand, it is very important what happens in raw material. Raw material should be valued, and there are again 2 points. If the finished goods, see, raw material was what? Suppose buttons, threads, okay, to manufacture the shirts. If finished goods, that is shirts, if finished goods can be sold at price which is higher than cost, okay, then if finished goods can be sold at price higher than cost, then raw material should be valued at cost, okay. But if finished goods can be sold at price less than cost, it means what? That we are incurring a loss. It means our finished goods cost was 50 rupees and we are selling it for 38. It means it is a loss for us. If it is a loss for us, then raw material should be lower of what? Cost and net realizable value. Understood? Very easy. We will solve some capsules. From that, again you will get a grip over this formula, okay. See, capsule number 5, what does it say? Raw material inventory of a company includes certain material purchased at rupees 100 per kg. It means the cost of raw material is rupees 100 per kg, okay. The price of the material is on the decline and the replacement cost of the inventory at the year end is rupees 75. It means the net realizable value, that is the market value of raw material, is rupees 75 per kg. Now if I ask you that at what price we have to value, as soon as I ask, the student will say, sir, lower of cost and NRV, and it will be wrong. Why? Because we have to check 2 conditions whenever we are valuing raw material. What are those 2 conditions we have just read? Read the condition about finished goods, if it can be sold at price higher than cost, or if finished goods can be sold at price less than cost, okay. Now it says it is possible to convert the material into finished product at a conversion cost of rupees 125, okay. So we are incurring a conversion cost of rupees 125 per kilo. Decide whether to produce the product or not if selling price is 175 and if selling price is 225. Now I can say I have 2 cases. Selling price is 175, selling price is 175 or selling price is 225. Selling price is rupees 225. Now understand, for valuing raw material, what were the 2 conditions? Finished goods can be sold at price higher than cost. What are the prices? We have 2 prices, 175 and 225. What is the cost of finished goods? That we have to calculate. How will we calculate that, sir? See, it means we can say this was 125 rupees per kg. So cost of finished goods will be how much? The cost of raw material was 100 rupees and we are incurring conversion cost. Conversion cost means when I am purchasing raw material, now we will do some process on that, some factory work and all those things, that is called as conversion cost. So cost of finished goods will be 100 plus 125, that will be rupees 225 per kg. Okay, now understand this. The cost of the product is, cost of finished goods is 225. Selling price is less than cost. It means I will write here selling price of 175 is less than cost of 225. This is of finished goods. If selling price of finished goods is less than cost of finished goods, then we can say value of raw material at cost or net realizable value, whichever is lower. And in our case, cost or NRV, which is lower? See, cost was 100, NRV is 70, therefore NRV is 75, which is lower, therefore raw material should be valued at net realizable value. Now understand one thing, they have also asked us decide whether to produce the product or not. See, if I produce the product, what will happen? The product cost itself was 225 rupees and we are selling at 175. So we will be having the loss of 50 rupees. But if I just sell the raw material of 100 at 75, we will have loss only of 25. So we should not produce the product. Okay. See, we will write a sentence here. If we produce the product, we will, or you can write here, if we will face the loss of 225 minus 175, that is rupees 50 per kg. Okay, but if raw material is sold, then loss will be 100 minus 75, that is rupees 25 per kg. Understood? Very easy. This is the same thing with the second case. Now, what's the second case is saying? That when selling price is rupees 225, again you can say that selling price is more than the cost. Cost was how much? 225 only. Okay, it is equal to cost. So you can say selling price is equal to cost. Okay, because selling price is also 225 and cost is also 225. We already know when the product can be sold at cost or at higher than the cost. I had to just change it at price more than or equal to cost, then you will value the raw material at cost. So I can write here that value of raw material should be at cost. How much was the cost? Cost was rupees 100 per kg. Okay. Now see why we are saying this. First I will write this line, therefore RM should be valued at cost. Why? See, if product is manufactured company will face no loss, because selling price minus cost, that is 225 minus 225, it will be 0. It means there is no loss. But if raw material is sold directly, company will face a loss of 100 rupees is the cost, but we can sell it in the market only at 75. That is our net realizable value. It means 25 rupees loss will be there. So we should produce the product. Okay. If I will sell the raw material directly in the market, I am facing the 25 rupees loss. But if I convert that into finished goods and then I sell in the market now, I will face zero loss. So we should produce the product. Understood? Now we will see the next topic. Next is, what is cost of purchase? Understand, cost of inventory includes three things, okay, that are, first is purchase cost, second is conversion cost, and the third is other cost. What are the three parts? See, we will learn this. The first is purchase cost. What do we mean by purchase cost? That is purchase price plus irrecoverable duties and taxes. Suppose we have purchased some raw material, okay, and we have paid taxes of 10,000 rupees on that. Now, tax of 10,000 rupees I have paid. Suppose I have purchased 1 lakh rupees raw material. On that I have paid GST of 10,000 rupees. Say we can say that this GST is recoverable from government. Okay, it will be given in the question whether it is recoverable or non-recoverable. If it is recoverable, then you will not add this in your purchase cost. You have to ignore. Whenever it is recoverable, ignore. But if it is irrecoverable, you will add this in the purchase cost. Simple. Then freight inwards means what? Transportation charges. If I am purchasing the raw material, obviously raw material will be transported to my factory. That transportation charges are freight inwards, and other direct expenses are in transit insurance. If suppose we are taking insurance, suppose we are purchasing goods or raw material from Jammu Kashmir and we have to transfer it till Tamil Nadu, Kanyakumari, like that, then we will obviously insure that. We will take an insurance for those goods, that is there. And then you have to remove trade discount and rebates. Whatever trade discount or rebate the supplier is providing, that we will remove from the purchase cost. Simple. Then after this we have here is conversion cost. Conversion cost means what? What am I spending after purchasing the raw material? What amount of money I am spending to make it a finished goods? Okay. So conversion cost is the labor I am employing to work upon the raw material, labor charges. Variable production overhead means what? That there will be so much electricity expenses, rent expenses, all those things. Those variable production overheads will be calculated on actual production. Okay. See, variable production, rent will become your fixed production, rent of your factory, that will be fixed production overhead. Overhead means charges only, the cost. Okay. Variable production overhead can be the electricity expenses or the fuel you put in your machinery, that is also variable expenses. Okay. Fixed production overheads will be calculated on normal capacity. Understand, there are two different things. First is actual production, second is normal capacity. What does these both terms means? Understand, if suppose we have a factory and in this factory obviously we are manufacturing what? We are manufacturing shirts and there are 4 machines, 1, 2, 3, 4. Okay. Each machine has a capacity of producing 100 shirts every day. 100 shirts every day. So what is my total capacity? Sorry, you will say, sir, total capacity is 400 shirts every day. Okay, that is called as normal capacity. That is called as normal capacity. But there is a possibility that sometimes there is a power cut, sometimes there is the labor problem, some problem or some or the other, and suppose we produce 370 shirts. Okay. So it means what is that 370 shirts? That is our actual production. Always remember, actual production cannot be more than your normal capacity. Okay. It can be at highest, your actual production can be 400 shirts. It cannot be more than 400 shirt. Okay. So normal capacity is 400 shirt. Actual production is 370 shirt. Simple enough. Now we'll read the definition of these both. Just a minute. Normal capacity means the production expected to be achieved on an average over a number of period under normal conditions. Okay. Fixed production overhead per unit will be revised only if actual production exceeds normal capacity. Suppose sometimes, or it is very rare, but if actual production itself is more than normal capacity, say 420 shirts we are manufacturing, because it is possible that we are doing overtime. Okay, now if the actual production exceeds the normal capacity, then inventories are not measured above their cost. Fixed production overhead will be revised that time. We will solve a question on that, don't worry. Okay, but remember, this is very important. Fixed overhead cost will be revised only when actual production exceeds the normal capacity. Understood? Now, fixed overhead cost, see, it is in the next here. Okay, I will tell you, wait. Now, understand, what do we mean by fixed production overhead? These are nothing but fixed costs which are related to the production. For example, say the factory rent. Now, you can say, let factory rent be 1,20,000 rupees per month. Okay. And if I tell you that normal capacity per month of our factory is, let's say, 6,000 units. Can you tell me fixed production overhead per unit? You will say, sir, it is very easy. The total cost is 1,20,000. 6,000 units we are producing every month. So we can say 20 rupees per unit is our fixed production overhead. Very good. But now if I tell you, let's say that normal capacity per month changes to 12,000 units. Then what will be your fixed production overhead? Then 1,20,000 divided by 12,000, which is equal to 10 rupees per unit. It means we can understand that as our normal capacity increases, the fixed production overhead will reduce, because per unit will reduce. Remember, the total fixed production overhead will be same, but the per unit cost will reduce, and it will be very helpful for us. See, because say first the product cost for us was, let's say, 170 rupees per unit, but if it has fallen from 10 rupees, now our product cost will become 160 rupees per unit. So it will have a very big impact on the cost per unit of our product. We will understand this by solving a capsule. See, remember this always, fixed production overhead will be calculated by dividing the total cost divided by, what are we using here? Normal capacity. But the formula is that you will divide it by fixed production overhead per unit is equal to total fixed production overhead cost divided by normal capacity or actual production, whichever is higher. Remember this, whichever is higher. Okay, do not write here whichever is lower, it is whichever is higher. Understood? We'll solve one capsule here. Capsule number 697. See, Dipesh Limited manufactures a product, okay, where raw material cost per unit is 25. So I can write here raw material cost per unit is 25. Then direct labor is 10 rupees. So direct labor is 10 rupees. Fixed overhead is 2 lakh rupees per annum. Now see, 2 lakh rupees is given for entire year. Okay, normal capacity is 5,000 units, but actual capacity, actual production is 4,000 units. There is no opening stock. Closing stock at the end of the year is 1,000 units. Okay, so we have to find the value of closing stock. That is not written here. Find the value of closing stock. How will we find it? See, be with me. Raw material per unit is 25, direct labor per unit is 10, fixed overhead per unit, if I have to find out fixed overhead, see, which is higher, actual capacity or normal capacity? You will say, sir, normal. So 2 lakh divided by normal, that will give you 40 rupees per unit. So you will write fixed overhead is 40 rupees per unit, and hence the total cost is 4, 5, 6, 7, 75 is your cost per unit of a final product. But this is not our final answer. See, this is your cost per unit. I have to find the value for 1000 unit. Therefore, closing stock value at 1000 units into 75 rupees, that is rupees 75,000. Understood? Very easy. We will solve one more sum that will give more clarity here. See, this is capsule number 8. Capsule number 9 we will solve first. Now, read. Capsule number 9 says, Rama Limited normal production volume is 1 lakh unit and estimated fixed overhead are 5 lakh. Okay. Calculate fixed overhead per unit to be absorbed when actual is 1,80,120. See, we will make a table here. It will become very easy for us to calculate. First case is when actual is equal to 1 lakh, or you can represent it like this. Actual production 1, 2, 3. Actual production is 1 lakh 80,000 or 1 lakh 20,000. Okay. How much is normal production? Normal production is 5 lakh. That will be constant. 5 lakh, 5 lakh and 5 lakh. Okay. Sorry, 1 lakh. 1 lakh, 1 lakh, 1 lakh. Now, which one we have to select? Always remember, we have to select out of these two whichever is higher. Okay. So therefore, here both are equal, so 1 lakh will be selected. Here also 1 lakh. Here 1 lakh 20,000. Why are we selecting this? Because we have to calculate fixed overhead per unit. See, fixed overheads are how much? Fixed overheads are 5 lakh rupees. So you will say rupees 5 lakh, 5 lakh and rupees again 5 lakh. These are your 1 lakh units. Units, units, units. So now if I have to find out fixed overhead per unit, it is very easy. This is your A, this is B. What is our formula? Fixed overhead divided by the units, whichever is higher. So I can just write here B by A. It will give me 5 rupees per unit. Again B by A, 5 rupees per unit. Again B by A. That is 5 lakh divided by 1 lakh 20. That will come around 4.17 per unit. Simple. Now, they are saying calculate fixed overhead per unit to be absorbed. This is your per unit fixed overhead, but we have to calculate one more thing here, that is calculate unabsorbed fixed overheads. What are unabsorbed fixed overhead? What are absorbed fixed overhead first? See, we have found out our fixed overhead. Okay, this is our per unit fixed overhead. How much have we absorbed? It means how many products have we produced. Absorbed fixed overheads will be the actual production multiply fixed overhead per unit. So it will be, for in this case, 1 lakh into 5 rupees, 1 lakh units into rupees 5. For here actual is 80,000, so 80,000 units into rupees 5. In this case 1,20,000 units into rupees 4.17, and the answers will be rupees 5 lakh we have absorbed 5 lakh. See, understand one thing, how much was the estimated fixed overhead? 5 lakh. How many units we produced? 1 lakh. It means the total cost is 5 lakh. Obviously in this case again 5 lakh is estimated cost, but how much is absorbed? How many goods we produced? Worth for rupees 4 lakh. So, and in this case again this will be 5 lakh. So you can see, understand what they want to say. The fixed overhead will always be 5 lakh only. We will always pay 5 lakh rupees as fixed overhead cost, always. But they said that in the first case we had a capacity of 1 lakh units and we produced 1 lakh units. That is very good. In second case our capacity was 1 lakh unit, but we produced only 80,000 units. It means, see, our capacity was to produce 1 lakh units, but we could produce only 80,000. It means we could not take the entire benefit of that 5 lakh rupees we have paid as a factory rent. Understand this. If I am working under my capacity, it means I am wasting my capacity. That is what we are talking. The capacity was to absorb 5 lakh rupees, but we could absorb only 4 lakh, or you can say we paid rent of rupees 5 lakh, but we could take advantage of only 4 lakh rupees. Like that you can say. If I tell you, you could take only 4 lakh rupees advantage, it means you lost 1 lakh rupees. That is your unabsorbed fixed overheads. This is your fixed overheads absorbed, but you could absorb only 4 lakh. We total spent 5 lakh. So 5 lakh minus 4 lakh, that will be your unabsorbed fixed overhead. In this case also it was 5 lakh, we have absorbed completely. So unabsorbed will be 1 lakh. C. You can name it as C, and we can write your formula. Unabsorbed fixed overhead is how much? Total minus absorbed. 0, 1 lakh rupees, 0. Understood? This is your fixed overhead concept. Now after this, the paste manufacturing is done. Okay, this was our fixed production overhead. We will do capsule number 6 now. Check. Anil Pharma Limited order 16,000 kg of certain material at 160 rupees per unit. Okay, so this is our purchase cost. The purchase price includes excess duty of 10 per kg. The purchase price already includes excess duty of 10 rupees per kg, in respect of which full Senvet credit is admissible. See, this you will learn obviously in detail in taxes, but I am just telling you here. It means what? It will receive full Senvet credit. It means the entire amount is refundable. Whatever tax you have paid, no, everything is refundable. Now, we learnt that if it is refundable, never add it in the cost. But question is saying this 10 rupees, it is already included in this 160 rupees. So the amount is refundable. You will get that back again from the government. So you will remove that 10 rupees from your 160. Remember to remove that. Okay. After that, freight incurred amounted to 1,40,160. Normal transit loss is 2%. Normal transit loss. See, there are two kinds of losses: normal loss and abnormal loss. Normal loss is 2%. They are saying, what does it mean? That while transporting the goods from here, means from, you say, from Jammu Kashmir to Tamil Nadu, or from wherever you are transporting, if you have lost some goods, that will be considered as normal loss. 1%, 2% is considered as normal. It will be always given in the question. Okay. The company actually received 15,500 kgs, okay, and consumed 13,600 kg of material. Very good. Compute cost of inventory under AS2 and amount of abnormal loss. See, whenever there is normal loss, we will ignore normal. We do not remove any amount from the cost. Okay, we just remove from the units because we have already lost the units. But whenever there is abnormal loss, In the case of abnormal loss, the amount will also be reduced, the units will also be reduced. See how we will do this. Our purchase prices how much? 16,000 kgs multiply rupees 160. It means how much is the final amount? 25 lakh 60,000. Okay. Then what we had to remove from this? Less excise duty, 10 rupees. So again 16,000 kgs into rupees 10, that is 1,60,000. We have to remove. What we had to add? We will add freight incurred. How much? 1,40,160. So 25,40,160. This is our total material cost. Understood? This is your total material cost. Now what have they asked? They have asked compute the cost of inventory. First understand how many kilos we purchased. You will say, sir, we purchased 16,000 kilos. Okay, 16,000 kgs was our purchase. Okay, if I tell you we have received only how much? 15,500 kilos. So it means 15,500. 15,500 kgs were received. But if I am telling you 15,500 kgs have been received by us, what happened to the left? How much is remaining? You will say, sir, remaining is 400, 15,500, 16,000, that is 500 kgs. Remaining is 500 kgs. Where is this stock? Sir, in the question it is given there is some normal loss. Where is the normal loss? Check. Normal transit loss is 2%. 2% of 16,000. Okay, the main amount, the main units we purchased was 16,000. So they are saying 2% is the loss. So if I tell you that, understand, please focus, out of 16,000 kilos what I ordered, I have received only 15,500. It means they want to say in transport we had a loss of 500 kilos. Okay, so I will say the loss was 500 kilos, but this is the total loss. How much was the normal loss? Normal loss was 2% already given in the question. 2% of what? 2% of the amount we purchased, that is 16,000 kgs. 16,000 kgs, 2% will be 320 kilos. So out of total loss of 500 kilos in transit, no, in transport I lost 500 kgs. Out of that 320 kgs is normal loss. Okay, so how much is the abnormal loss? Abnormal loss will be the remaining portion. Remaining portion is how much? 500 minus 320, that is 180 kgs is my abnormal loss. Now understand this. For the abnormal loss, whatever is our abnormal loss now, that abnormal loss will be transferred to the profit and loss account. And the normal loss, what do we have? This normal loss, that will affect our cost per unit. See how? Understand this. Total material cost is this much. Now number of units will be how much? Number of units, I have already told you the normal loss should be removed from number of units. So my number of units were 16,000 kgs. I have to remove normal loss, that is 322 kgs. It will become how much? 15,680 kgs. Okay. Now what we have to find? We have to find cost per kg. Okay. Cost per kg, how will we find? The total cost divided by number of units, 15,680, that is rupees 162 per kg. This is my cost per kilo of the material we have purchased. Understood? Now, why we calculated this? See, after calculating this, it will be useful for us to calculate two things. First is how much is the abnormal loss. Second will be how much is my closing inventory. Okay. So, closing inventory. How much is closing inventory? I received totally 15,500 kgs. Okay. Out of that, see, 13,600 kgs of metal was consumed. So we received 15,500. 13,600 kgs is consumed. So you can say 1,900 kgs is still in our godown. So for closing inventory, value will be 1,900 kgs multiplied by rupees 162, that is rupees 307,800. Simple. This is your value of closing inventory. Now, how much will be the abnormal loss value? See, where will this closing inventory go? In your trading account. Okay. Now, if I tell you value of abnormal loss, value of abnormal loss is how much? Totally abnormal loss was 180 kilos and cost per unit is 162. So 180 kgs into rupees 162, that is rupees 29,160. This is your abnormal loss, which will be transferred to profit and loss account. Okay, understood. This is your abnormal loss, normal loss and closing inventory valuation. How we have to deal with see, in this capsule we have learned three things. Okay, first is we have to remove the refundable tax. Second is normal loss. Third is abnormal loss. Understood? This question is very, very important. Please do solve this question. Okay, this was our capsule number 6. We have learnt fixed production overhead, purchase cost, conversion. Capsule 6 Anil Pharma, 7 Dipesh Limited, and then we have solved 9 also. From the capsule number 8, this is also a question which includes so much of part, that is just like the previous question we have solved, and then we will move to the next topic of joint products. Okay, that we will see in the next part. Thank you.